Throughout the last two lectures, we looked at a put credit spread and a call credit spread. I don't know if you were thinking about this, but you'll notice that you put these trades on both sides of the current stock price. So you could actually combine these two together to create a market neutral trade called an Iron Condor. Let's dive in and explore what an Iron Condor is. Let's review the profit and loss chart for both a bull and a bear credit spread, the put credit spread and the call credit spread. You'll notice they both kind of hover around the current stock price of $100. The call credit spread makes profit if the stock goes down in value, and the put credit spread makes profit if the stock goes up in value. But you'll notice there's kind of this window between the 95 and the 1010, where if the stock remained in that window of time, both these trades would become profitable. So being bull and bear does not necessarily mean the stock has to move in one direction or another. It just doesn't have to move too much in one direction. So what's neat about this is we can combine these trades and potentially make an even bigger credit when we put these trades on. So let's take a look at how to build these trades. Let's build our Iron Condor one side at a time. We'll start with an empty profit and loss chart with the current stock price at $100. And over here, we might have the call option that we sell, and then the call option that we buy. And over here, we have the put option that we sell, and the put option that we buy, leaving the current stock price right in the middle. Let's add the call side to our empty profit and loss chart. Here, we're going to use our fictional company, Acme Inc., and we're going to sell a call at a strike price of 110. And we're going to buy a call at a strike price of 112. Of course, this is a credit spread, so we'll receive a credit. In this case, we'll receive a credit of 25 cents. Like any call credit spread, we start to lose money as the underlying stock price goes up past our short option strike, and we tend to keep our credit if the underlying stock price stays below our short option strike. Now let's put on the put side of our Iron Condor trade. In this example, we sell short the 90 strike price and buy long the 88 strike price. And just for example, this gives us a 25-cent credit as well. In reality, usually the put side gives a little more credit than the call side. And the reason for that is there's a lot more buyers of puts, because puts can be used as to hedge a stock portfolio, while calls tend to be more used to put trades like this on or to make a big bet towards an upside of a trade. Hence, since puts are used to hedge as well as other speculative trading, they tend to bring in a little more premium and as a result have a little more credit. But in this example, we're going to assume they both have a credit of 25 cents. So as you can see, we have the put side over here, the profit loss chart, and the call side over here on the profit and loss chart. And they're all hovering around the current stock price of $100. As we learned in the past slides, we received 25 cents for both sides of this Iron Condor. By adding them together, we receive a total credit of 50 cents. So we're actually doubling the credit we receive by placing these trades together. But unfortunately, we're increasing our risk because this trade can go to our max loss on either direction. We really need the underlying stock to stay between the 90 and the 110. This is considered a market neutral strategy. When you think the market's not going to go down by too much or up by too much, you might place an Iron Condor. Or this is considered a market neutral strategy. If you don't think the stock price is going to go down too much or up too much, you might place an Iron Condor. Or with the extra credit, you might be able to make your wings much wider so you give a much bigger range for the stock to move up or down without threatening your max loss. So Iron Condors can be incredibly profitable because they bring in extra credit, but they also can be a little extra risky because you don't necessarily have the safety of freedom for the stock to go up too much or down too much. It has to stay in that narrow trading range that you define when you select your strike prices. A neat feature of the Iron Condor is we know at expiration, one side will expire worthless. It's not possible for both sides to be threatened and go to max loss. So therefore, we can take the entire max credit received, so in this case 50 cents, and subtract out our short strike by the 50 cents to get our break even. So our break even tends to be just a little bit further down away from the short strike than it is with just a put credit spread or just a call credit spread. The fact that one side will always expire worthless is a powerful tool when evaluating an Iron Condor. Let's review what we just learned about the Iron Condor trade. The Iron Condor trade is going to be perfect if you think the stock price is going to be flat, meaning the market's not moving in any one direction up or down. We call this a market neutral trade. The goal of this trade is to make sure the underlying stock does not move in any meaningful direction, meaning the put or the call legs are never challenged. One of the advantages of the Iron Condor trade is we receive almost double the credit when we open the trade relative to a put or a call credit spread. This is because we're receiving credit on both sides of the trade. As a result, our break-even points are even wider from our short strikes. Since at expiration, only one side of the trade can technically be challenged, we know the other side will expire worthless. So this has some advantages when it comes to broker margin. More on that in a second. The max risk is the width between the short and the long legs minus the credit received. Typically with an Iron Condor, the width between the short and the long legs on both the put and the call side are the same. There are cases where those might be different, but that's a more advanced Iron Condor trade, and we'll learn about that more in another lecture. But in our example, the width was $2. Depending on your broker, Iron Condors can be more expensive in terms of commissions relative to just a vertical spread, put or call. That's because you're buying more options contracts, 2 more options contracts per lot. And a lot of brokers charge per options contract in terms of commissions. So when evaluating Iron Condors relative to put or call credit spreads, you really want to take into consideration maybe that extra commission. Relative to credit spreads, Iron Condors seem like they might be less risky because you're receiving more of a credit. However, inherently, they are more risky because you can lose money if the market moves in either direction. With a normal vertical spread, you only lose money if the market moves too much in one direction. To offset this extra risk, an interesting feature of Iron Condors is you might be able to close a trade much earlier than you would with a vertical spread. Let's say with a put credit spread, your strategy says that you close a trade after you've captured 50% of the credit. With an Iron Condor, you could close the trade at 25% of the credit and still have the same profit you would have had if you just did one vertical spread. So with an Iron Condor, the advantage is you might be in the trade a lot less time, and as a result, you might not give the market enough time to threaten either side of your Iron Condor. So once again, it kind of comes down to the strategy you choose. And just to reiterate, because we can close the Iron Condor sooner typically, this de-risks the trade as it does not give the market enough time to challenge either leg of your Iron Condor. Another feature of an Iron Condor is its flexibility. What I'm talking about now is a little more advanced, and you probably should consider further down the line of your options trading journey, but I wanted to give you some concepts of what the Iron Condor could do now. One of the flexibilities of the Iron Condor is you could close one side. Typically, you put the Iron Condor on and you close the Iron Condor, but you could close one side and convert it from an Iron Condor to a vertical spread. Let's say the market's moving up a little faster than you expected, and it's starting to threaten your call side. What you could do is close the call side and make it into a put vertical spread. That's an option. Another option is you can roll one side out further. Rolling is when you just close let's say in this example, the call side. You could close the call side and maybe buy another call further up, meaning buy a call spread that's further out in the money, de-risking the trade a little bit further. Rolling options is a complex topic, and we will cover that in further lectures. But I just wanted to highlight the point that Iron Condors do have the flexibility because you can break them apart and de-risk, increase your profitability, or whatever you want to do throughout the life of the trade. And one last advantage of Iron Condors is since only one side of the trade can turn into a loss, we know the other side will expire worthless. Brokers do not require double the margin. So they have the same margin or capital requirements as a vertical spread. So what's kind of neat is instead of putting on a vertical spread, you can put it on Iron Condor and get double the credit for the same amount of margin needed in your account. So that's an interesting thing to consider when building out your Iron Condor trading strategies. As always, I want to highlight what we just went over was the mechanics of an Iron Condor trade. We really didn't talk about strategy. You need to take the trade mechanics and combine it with a strategy in order to build a profitable trading system. So I'm not going to go into great detail in this slide about how to build a strategy around Iron Condors. We're going to do that in later slides. But I wanted to give you some things to think about so when we do get to those later slides, you're already thinking about it and maybe you've already come up with some strategies of your own. In the example trade, we earned $50 by risking $150. The idea is if we trade this over and over and over again, we'll have a profitable trading strategy. In this example, if we had 3 winning trades in a row before our losing trade, where we had a max loss of $150, we would have only broken even over 4 trades. So if we want a profitable trading strategy, we have to do a little better win ratio than 3 to 1. For example, if we traded 6 trades in a row, we would have a profitable trading strategy. And then we just want to do the strategy over and over and over again to have consistent monthly profit. But the question is, how do we build that strategy? We build that winning strategy by calibrating our strikes, our expirations, our deltas, and so much more. When opening a trade, we get to select which strikes we buy and sell, how wide our Iron Condor is, the deltas we use, the expirations we use. There's so many variables that go into doing trade selection when we open the trade. And through that calibration is how we can take a strategy from potentially being a losing strategy to a winning strategy. A lot more on that in later slides. I just wanted to get you thinking about that. Also, part of fine-tuning a good strategy is the time that we exit the strategy. We talked about potentially holding the Iron Condor till expiration. We talked about maybe taking the Iron Condor and selling it after you've recouped 25% of the credit. So the exit is also a component to how you build your strategy. Sometimes you want to exit the trade as soon as possible to lower your risk. You'll be giving up some credit for that. And sometimes you want to hold on to the trade almost to expiration. It all comes down to the strategy that you build yourself through your own risk reward and the goals that you have as a options trader. Lastly, when building a strategy, sizing is very important. Sizing is how many contracts you buy. In the example we did before, we only bought 1 lot, meaning we only bought 1 contract. But we could have bought 10 contracts. And if we bought 10 contracts, our credit might have gone to 500 and our risk might have gone to 1500. So the more contracts you buy, the more credit you receive and the more risk you have. So if you have a strategy that trades often, you might want to just have a real small lot size because you're doing it over and over again. And if you have a strategy that you don't trade that often, maybe you want a bigger lot size. It's all part of the strategy of figuring out how much risk makes sense for what you're doing. And lastly, with sizing, you want to make a strategy of when you increase your lot size and when you decrease your lot size. Maybe after many profitable rounds, you might want to increase your lot size to help compound the strategy. And maybe after some drawdowns, you might want to decrease your lot size to preserve your capital to get you through the drawdown. So every strategy is different. And that's why that's a whole different topic when we get to trade strategy. But I just wanted to start to give you some preview of what you might do with Iron Condors. And just to highlight, it's not just a trade. You have to marry a trade with a strategy. And now for the fun part. Let's build this trade. Let's open the browser and head on over to Options Strat. That's where we'll visualize this trade and look at the different strikes and expirations that we might choose. And after that, we'll head on over to our online broker and actually place this trade. We'll figure out how to select the different legs and open the trade up. And then once it's open, we'll learn how to close the trade through real market fills. Well, not real, through my paper trading account. So let's head on over there. Well, here we are at Options Strat. Let's go to the Build tab and look for the market neutral strategies, and we'll find Iron Condor. And it defaults to being set to the SPY, and the SPY is currently trading around $502. It defaulted to 63 days to expiration. Let's bring that more into maybe 21 days, 28 days, about 30 days. You know, there's no reason. Well, your strategy will dictate your expiration. I was just kind of throwing something out there. Remember, the bottom of the strikes are the short strikes and the tops are the long strikes. So we're at 502, so let's maybe go out to like 480. And then we'll buy maybe the 478. And you'll see right now this is super lopsided, which you could place this trade if you wanted to. But let's take this, let's go out to like the 530. Let's go to 522 and then buy along the 524. So here we receive a credit of $34 and then have a max loss of $166. And if we look at the stock price here, we go all the way out here. This trade is about 4%. So the stock market can't move any more than 4% one way or another, or this trade will start to get tested. And, you know, we could look at what does different expiration dates look like. Maybe go out to June. Just keep playing around until you find a good trade that works for you. Typically around 60 days, it's probably too far out for this type of thing if you're looking for a fast decay on the premium. So usually about 30 to 45 days is ideal. But once again, it's all about your individual strategy and what you figure out, the parameters that you calibrate to make your strategy profitable. That's what this looks like in options strat. And so let's head on over to the broker and actually place this trade. Here we are on my paper trading account with Tradier, one of my favorite brokers. And you'll notice we have an empty account, we have no trades, and we're just all in cash. So something I want you to pay attention to is this $68,396 cash number and the options requirement being 0. So let's go ahead and place our first Iron Condor trade. So let's go to chains and let's trade this on the SPY. So we'll type in the underlying stock price. And then you'll notice here it gives us all the possible options. We want to narrow this down to say 50. It gets a little too overwhelming. And then we want to go out a little further in time. So we want to filter. So we're currently looking at the options that expire on February 16th. Maybe we want to go out to like February 16th. And once again, since we're trading the SPY, we have almost options for every expiration date. If you're trading individual stock, it might be more monthly versus every day. So let's go March 15th. Maybe the 16th is a weekend or something. And so now what we want to do is we want to build our Iron Condor. So we come down here, we start where the market shifts from in the money and out of the money. Because we currently know the SPY is currently trading at about 502. So we'll come down here and we'll do the call side first. That means we want to go out of the money, which is the white area, up further. So if we're at 102, maybe we want to start at like 522. We'll sell the 522. And I like to do kind of a 2 width wide Iron Condor. No reason. Your strategy will pick whatever you want. So we'll go to 524. So we're going to sell the 522 and buy the 524. So we're here at the 502 and we want to go down to about 18 points because that's what we did over here. So let's go up to 482. So it's about 18 points. And we'll sell this on the put side. And then divide our risk. We're going to buy the 480. So, and once again, I'm using it 2 points wide strike price, but you could pick whichever you wanted. And so then now I have my trade kind of selected on the chart here, and I'm going to send a ticket. And I'm going to do like a 10 lot. So we're going to buy 10 contracts of each. You'll see we have the mid, the bid, and the ask. I'm going to put it just a little below, or first of all, I'm going to do a credit. So this is telling the broker we want to receive money, not pay money. And then normally we could keep this around the midpoint, but I'm going to put it a little below the midpoint just so we know it fills, being a paper trading account and everything. So let's go for 30 cents. Hit preview, hit submit. And so you'll see one thing to note here is our commissions are much higher because we're buying a lot of contracts. So if we're just buying a put credit spread or a call credit spread, this would be about 50% less. So about $7. So we're bringing in about $300 for this trade. So let's submit that and we'll head on over to the dashboard and you'll see the trade filled a little better than we expected at 0.33. So we pulled in 33 cents per share for this, or $33 per share, I should say. Now we own this position. Now let's pretend it's further days in the future here, and we want to close it. This options trade has decayed. What we could do is come over here and select all of our options, and we want to close them all at once. So you'll see we have all of the options, and it changed from buy to open to buy to close, sell to close, sell to close, buy to close. And then since we're closing it, this is going to be a debit. We're going to pay out. Net debit here. And normally this number would be much lower, but since we didn't give enough time, we're just going to pick any random number. So I'm going to say 0.40 because we really want this to close in this demo here. And also before I close this, I want to go back to this number and you'll see we now have a $2,000 options requirement. That's the margin the broker's holding in case we get to our max loss, because the max loss is $2,000 on this because we're $2 away on both sides of the spread. But you'll also notice the cash went way up. We received a credit when we sold the Iron Condor, so that credit cash deposits into our brokerage account. So let's go ahead and close this trade. So we're gonna hit preview and hit submit. We're asking to pay for 400. I don't think it'll probably close lower than that. So hit submit and head on over to or close the trade out, and it filled right away at 439. So in a normal trade would have brought in 33 cents and maybe closed at expire or maybe closed at 20 cents or whatever our strategy is. But the number that you close at should be much lower than what you opened it for. So you keep the difference in premium. And now that's closed, you'll see our options requirement's gone away. And normally our cash value would be higher because we made a profit, but in this situation, since I did an example trade, we actually lost a little money. But I just wanted to walk you through the mechanics of opening and closing an Iron Condor within a broker. So hope that's helpful.